Hello and welcome to Understanding Financial Accounting Information Training. Today we will discuss the definitions of profitability and liquidity, graphs that illustrate how profitability and liquidity values change over time, and an example of a family-owned restaurant business. In this example, you will have a chance to apply the definitions of profitability and liquidity and demonstrate what you have learned about financial statements. Profitability. Owners, investors, managers, and stakeholders need to understand a business's profitability. What is the difference between profitability and profit? Profitability is a measurement of efficiency and ultimately a business's success or failure. Profit is the difference between revenue and expenses. Revenue is money brought in as a result of sales and/or services. Expenses are money paid out to make businesses operate. Examples include paying people, renting building space, and purchasing products. Look at the example here. The accounting flow visualizer's circle shows us revenue and the pie wedge depicts profit or loss. The amount of money or revenue that the business brought in is reflected in the size of the circle. The profit or loss resulting from operating is depicted as a portion of the revenue circle. When there is a profit, the wedge is green. When there is a loss, the wedge is red. The size of the wedge indicates the profit percentage. In year 1, the wedge is red, which means the business operated at a loss. In year 3, the wedge is green, which means the business operated at a profit. Please note, you can see the profitability line of the graphs on the right-hand side going up in year 3 and continuing in year 4. This means the business operated at a profit in those years. Please remember, all we need to pay attention to is the pie wedge. If it is red, it means the business spent more than it brought in, and it has a loss. If it is green, it means the business spent less than what it brought in, and it has a gain. The operating profit is an important line item. When we hear stakeholders say, "I only care about the bottom line," it means they only want to know if the business is making a profit or not. Did the business's profitability grow or shrink? Although traditional financial statements show financial data in numeric form, this presentation shows financial data in visualization to communicate key financial issues. These 4 pie charts and the associated graphs show the profitability of a hypothetical business. Some years had losses, some had gains. Year 1 and year 2, the pie wedge is red, which means the business operated at a loss during the first 2 years. Year 3 and year 4, the pie wedge is green, which means the business operated at a gain or profit during year 3 or year 4. Please note, you can see the profitability line of the graphs on the bottom of the pie charts going up in year 3 and continue in year 4. This means the business operated at a profit in those years. Please remember, revenue is an important factor in determining profitability of a business. As you can see in the line graph example, profitability line growth year over year. In year 1, the profitability line was a negative 12%. It means the business operated at a loss. In year 2, the profitability line got picked up but still is at a negative. It means the business still lost in year 2, but the loss is much smaller than in year 1. Then, the profitability line in year 3 and 4 really increased. This means the business generated profit in year 3 and year 4. Understanding the key factors determining profitability assists leaders in developing an effective profitability strategy for their business. Liquidity. What is liquidity? Liquidity refers to the ability of a business to keep its current asset balance to pay its current liabilities so that operations are not disrupted by cash shortfalls. Current assets in this example are cash and receivables. Receivables are considered current assets because it is money a business expects from customers within 30 days. Current liabilities in this example are payables. A simple question to ask is, do we have enough cash to pay our bills? Why is liquidity important? Many businesses crash because they run out of cash. Cash is the water that keeps a business from dying of thirst. Having the ability to pay bills in the coming months is extremely important to businesses because even businesses that have a good plan for the long term may have to close their doors because they don't have enough cash. In this example, the green box shows current assets, which includes cash and receivables. The red box shows current liabilities, which includes payables. Please look at year 1 and year 2 in this example. In year 1, the green box of current assets shows that this business had cash in the bank at the end of the year to pay its bills. This means the business is liquid because after paying off its payables, it still has cash in the bank. In year 2, the green box of current assets shows that this business also had enough cash in the bank at the end of the year 2. Even though the current assets in year 2 is much less than the current assets in year 1, this business still meets its obligation to pay off its bills. When the green box, current assets, is bigger than the red box, current liabilities, the business has positive liquidity. The bigger the difference, the more liquid a business is. Please note the line graph on the far right hand side shows year 4 of the current ratio. The current ratio shows the proportion of current assets to current liabilities. The current ratio is used as an indicator of a business's liquidity. Here is a question to think about. How do we determine a business's liquidity? Of course, the answer is that we look at the difference between the total current assets and the total current liabilities. Remember, total current assets includes cash and receivables, and total current liabilities includes payables. Which images show more liquidity? This image here summarizes a business's assets and liabilities. If users want to know whether a business has enough cash, total assets, to pay upcoming bills, current liabilities, or not, they will need to look at this rectangular graph image. The green box shows current assets, which includes cash and receivables. The red box includes current liabilities, which includes payables. Here is the image that shows a 4-year period of the business's current assets and current liabilities. Financial visualization tools let us communicate financial data in pictures. In this visualization, the graphs are designed to communicate useful information about the operation and position of a business. They are the most objective way to assess the health of a business. Information from the pie charts show a business's profitability or poverty, and information from the rectangular chart shows a business's liquidity. How do financial visualization tools illustrate issues? Continued. If users want to know if a business is profitable or not, they will need to look at the pie chart. Please take a look at the pie chart here. The circle depicts revenue, and the green wedge shows profit. The difference between the two indicates expenses. This visualization identifies the expense as labor costs, which is shown in blue. Revenue, expenses, and profit have a direct relationship. An increase in any type of revenue increases profit, and an increase in any type of expense lowers profit. Remember, when you want to know if a business generates profit or not, you just need to look at the green wedge or the red wedge. Green means profit, red means loss. Many stakeholders refer to this as the bottom line. If users want to know if a business has enough cash to pay its upcoming, they will need to look at the rectangular chart. Please take a look at the rectangular chart here on your right hand side. The green box shows current assets, which includes cash and receivables. The red box shows current liabilities, which includes payables. If current assets are more than current liabilities, the business is liquid. If current assets are less than current liabilities, the business is illiquid. Example: we have discussed profitability and liquidity, and how financial visualization tools illustrate issues. Now we will look at an example of a Venice Italian cuisine restaurant. First, let's look at the background and history of the Venice Italian Cuisine restaurant. The Venice Italian Cuisine restaurant is owned by Mr. and Mrs. Epicito. The Epicitos focus on the goals of quality, healthy, and tradition. The restaurant values are honor the customer, serve quality food by making each dish from scratch. Please note, to start this business, the Epicitos obtained a $100,000 commercial loan from Wells Fargo and used that money to purchase the restaurant's kitchen equipment, furniture, and decorations, and began hiring kitchen and floor staff. Example continued. Here you see two financial visualization tools, the pie circle graph on the left and the rectangle graph on the right. These are the two financial visualization tools that we discussed in the previous slides. Now let's talk about profitability. In order to understand whether the restaurant is making a profit or not, the Epicitos need to track both money received and money expended in a given time period. This information is obtained from the income statement. Money received is money brought in as a result of activities such as sales or services. This is also called revenue. Money expended is money that is spent to generate revenue. This is also called expenses. The pie circle is a running tally of money that flows during a specified time period. Year 1. Please take a look at the circle on the left hand side. The circle depicts revenue and the red wedge shows loss. This means the Epicito operated at a loss in the restaurant's opening year. Remember, the pie circle focuses on revenues, expenses, and the profit or loss report that is generated from subtracting the expenses from the revenue. Revenue minus expenses equals profit or loss. This is very important for the Epicitos to know because it tells them how their restaurant is doing during a given time period. Remember that when a business spends less than it brings in, it makes a profit. When a business spends more than it brings in, it has a loss. Please note, you can see the profitability line of the graph on the bottom on the pie chart going up in year 3 and continue in year 4. This means the business operated at a profit in those years. Now let's talk about liquidity. A business's liquidity is its ability to meet its short-term financial obligation as they come due within a 12-month period. Liquidity considers cash that the restaurant has in the bank at the end of each year. Please note this number may have gone up and down during each year. To assess the business's liquidity, the Epicitos need to look at two things: how much current assets the restaurant has, which include cash and accounts receivables, and 2, how much its current liabilities are due in payables, such as what is owed to its suppliers. Remember, cash plus receivables minus payables equals net liquidity. Now, look at year 1. Year 1, total current assets, cash and receivables, were larger than current total liabilities, payables. This means the business is liquid. Please note, the line graph on the bottom of the rectangle chart shows 4 years of the current ratio. The current ratio shows the proportion of current assets to current liabilities. The current ratio is used as an indicator of a business's liquidity. In this section, we will compare the Venice Italian Cuisine restaurant to the Oregano's restaurant. Although the Venice Italian Cuisine restaurant has been liquid since year 1, it did not make a profit during the first 2 years. This really worried the Epicitos. Mr. Epicito understands that it is normal for a new restaurant to operate at a loss during the first 3 years. However, when the restaurant operated at a loss during year 2 and made very little profit in year 3, the Epicitos decided to do a competitor analysis. This analysis lets the Epicitos compare their restaurant to their competitors. They hope to identify differences that could make their businesses more profitable. After identifying the Oregano's restaurant as one of the biggest competitors to the Venice Italian Cuisine restaurant, The Epicitos decided to focus on the Oregno's customer target, marketing strategy, market share, prices, menu, image, and growth. The Epicitos' main focus in marketing was to increase customer awareness in the surrounding communities. The Epicitos hoped that word of mouth would be the main marketing force. The Epicitos created an appealing environment with exceptional prices using a high quality and diverse menu. In year 4, Mr. Epicito was able to use the analysis to make changes in the Venice Italian cuisine restaurant. Instead of serving only dinner from Tuesdays to Sundays, Mr. Epicito decided also to serve lunch, have the restaurant open for 7 days a week, and add delivery services. Mr. Epicito changed his menu to offer a wider range of items for both service times while continuing to offer superior food quality and keep the menu prices under $20. By the end of year 4, the restaurant's reputation had spread throughout the community. Its name became synonymous with delicious Italian food. Customers enjoyed the fine dining experience and upscale ambiance of the Venice Italian cuisine. Customers found the prices reasonable and were happy with the diversity of the menu. Compared to year 1, revenue at the Venice Italian cuisine restaurant improved. In year 1, the red wedge meant the restaurant operated at a loss. In year 4, the green wedge showed the restaurant was operating in a profit. Now, let's review the profitability and liquidity of the two restaurants. Ask yourself questions regarding profitability. Was the Venice Italian cuisine restaurant more profitable in year 1 than the Oregno's restaurant? The answer is both restaurants have the same loss. How about in year 4? The Oregno's restaurant is doing better because its green wedge is larger than the Venice Italian cuisine green wedge. Now ask yourself questions regarding liquidity. How do you determine the restaurant's liquidity? Let's look at the total current assets and the total current liabilities. If a business has more total current assets than total current liabilities, then it is liquid. If a business's total current assets is less than its total current liabilities, it is illiquid. Does the Venice Italian cuisine restaurant have more liquidity than the Oregno's restaurant in year 1? Of course. How did you figure this out? The green box that represents the total cash from the Venice Italian cuisine restaurant looks bigger than the green box in the Oregno's restaurant. Does the Venice Italian cuisine restaurant have more liquidity than the Oregno's restaurant in year 4? Of course not. The green box representing the total cash from the Oregno's restaurant looks bigger than the green box of the Venice Italian cuisine restaurant. Please take a moment to see if you understand the definitions of profitability and liquidity and know which financial statements to look at when you need to answer profitability and/or liquidity questions. We are done with our training section. Now, in this slide, I will show you how to maneuver the financial visualization tools. When you open the link regarding the kitchen and saltwater restaurants, you will see this page of images. If you want to see year 1, please click on Back to Start button. If you want to look at year 2, click on Year 1 to Year 2 button. If you want to look at year 3, click on Year 2 to Year 3 button. And if you want to look at year 4, just click at the Year 3 to Year 4 button. If you want to make the screen larger or smaller, all you need to do is hold down the Control button and the plus or minus sign. Please review the information from these statements carefully and complete your survey questionnaire. Thank you so much for watching this video training and completing the survey questionnaire.